One misconception that I often hear related to short-term rental is that just because you put your rental on a short-term rental platform like Airbnb, the net loss from the short-term rental will offset your W-2 income. That is not necessarily true. So today I want to share with you two fundamental tax concepts that you should know if you have a short-term rental. And I want to share my recommendations so that you can actually utilize your short-term rental loss to offset your W-2 income. So the first tax concept that I would like to share with you is that all rental activities are passive activities. Let me repeat. All rental activities are passive activities. This means that a passive activity loss cannot be used to offset non-passive activity income. So for example, say that you have a long-term rental and your rental generated a net loss. Your rental loss, which is a passive loss, cannot be used to offset your doctor's income. This is a general rule, but there are exceptions, thankfully. One of those exceptions is that if your income is less than $100,000 a year, then up to $25,000 of the passive loss from the rental can be recharacterized as non-passive loss. So you can actually use that loss to offset your income as a physician. But I imagine that most of you guys have an income greater than 100 unless you're a resident and it's not moonlighting. This exception will probably not going to be applicable to you. So this is where the short-term rental loophole or strategy comes into play. So this strategy allows a short-term rental activity to be categorized as a non-passive activity, from passive to non-passive activity, so that the net loss from the short-term rental, once recategorized as a non-passive activity, can be utilized to offset your other non-passive income, like your physician's income. But what I realize is that a lot of people don't know that you have to meet two requirements to be eligible to utilize a short-term rental strategy. So what are those two requirements? So the first requirement is that the average customer stay is less than 7 days. To determine that, you just add up all the rented days and divide that number by number of guests that you had the whole year. So if that number is less than 7, that means your average customer stay is less than 7 days. You met the first requirement. The second requirement is that you materially participate in the short-term rental activity. What the heck does that mean? I think it's a very foreign tax concept that can be very confusing. So let me simplify for you. So there are commonly 3 ways to pass the material participation test. The first way is to spend more than 500 hours performing day-to-day management activities like cleaning, turning the unit, responding to customer requests or complaints, dealing with repairs and maintenance. So spend 500 hours doing these. The second way is to spend more than 100 hours, not 500, and more than anyone else in the short-term rental activity. So that means this test requires a time log of every single individual involved in your short-term rental so that you can prove that you spent more hours than anyone else. So this is more time intensive. So third way is to essentially have nobody else involved in the rental activity but you. This is called substantially all tests, which means substantially all the hours spent into short-term rental activities are hours that you spent. So just to recap, to utilize a short-term rental loophole, whose goal is to turn the rental activity into non-passive activity, you must meet two requirements. The average customer stay less than 7 days, that's one, and meeting the material participation test, that's a second requirement. And the tax benefit from that is that you can use the net loss from the short-term rental to offset your doctor's income. But in my opinion, I think the meeting the material participation test is the most troublesome for most physicians with short-term rental. Why? We are busy. We hire a management company that does all the work. That means you would unlikely meet the material participation test because, one, you probably won't spend 500 hours in the activity unless you have many rentals. Two, you will unlikely spend more hours than any other individuals involved in the activity, like property manager will spend more time than you. Three, you will fail the substantially all tests because there are other people involved in the activity, right? So you're busy. So, I thought about owning a rental, short-term rental, in Waikiki, where we vacation a lot with my family. I love it. I work as a physician, live in LA. So I thought about how that's going to work in terms of meeting material participation tests. Because I can't physically be there to clean the room, turning the unit. I would actually have to hire people to come and do the work, right? So unless I have multiple cleaners all lined up, taking turns to clean the unit, and I have a log to prove how many hours each cleaner spent, so that I can prove that I spent more hours than them, and those hours have to be more than 100 hours, it's going to be really hard to meet the second material participation test, which is 100-hour plus and more than anyone else test, right? So my general recommendation for most physicians is that if you're thinking about having a short-term rental, have it in your backyard. So you can easily prove that you have spent more than 100 hours and more hours than anyone else managing the unit yourself, right? So you can meet the material participation tests. So the takeaway from today's content is, one, all rental activities are passive activities. And two, one exception to that is a short-term rental strategy where having an average customer stay of less than 7 days and passing one of those material participation tests can reclassify your short-term rental activity to non-passive activity so that you can use a net loss from the rental to offset your doctor's income so that you pay less in taxes, keep more in your pocket. Okay, hope this helped, and I'll talk to you guys next time.